I'm your instructor, Christopher Lewis, and in my 15 years of trading experience, there's one thing that continually shows up on the charts. That's consolidation. Consolidation is just simply when a market goes from one level to another and repeats multiple times. This is true on multiple time frames. It really doesn't matter the time frame. You will see consolidation because, quite frankly, a market cannot go in one direction forever. Even in a massive uptrend, you will see the occasional sideways action as those who got in at a lower price might be selling their shares or pounds or whatever they're buying back into the market to collect profit. Generally speaking, you have a debate as to whether or not the value of the asset should go higher. Quite often, you will see this happen when fundamental news is coming. For example, one of the most common times to see consolidation is the Asian morning and European morning sessions on a non-farm payroll announcement in the United States. Very few people are willing to throw a bunch of money at the market when they know that at 8:30 New York time, we're going to see a lot of volatility. There's no point in taking the unnecessary risk. However, there are times of the year where consolidation is just a matter of fact. It's because nobody's in the market. For example, between Christmas and New Year's Day, that's generally a very quiet time of year. Markets don't go straight up or straight down, and that's why we have consolidation. If they did that, there wouldn't be much of a market. You would just simply buy or sell something and then collect all the money in the world. So clearly, it's not a viable premise. That being said, it's easy to get faked out when it comes to consolidation. So I'm going to show you how to use the stochastic oscillator and a moving average in combination to understand whether the stochastic oscillator should be used and when it's time to buy and sell. You should keep in mind that consolidation doesn't last forever. So if you just simply take every signal, the idea is maybe you get 4 or 5 wins and then eventually you take a loss. There are some other ways to mitigate that as well, and we'll explore that in this video. In front of you, I have the euro against the US dollar on a daily time frame zoomed out so that you can get a better appreciation as to what a sideways market can look like. Now, granted, there are peaks and valleys as we go along, but you can see that for the last 2 years or so, the market has essentially been trading between 1.05 on the bottom and somewhere around 1.11 on the top. So you have a 600 pip range. How do you navigate this? Well, I would point out a couple different things. On this chart, there is a 50-day EMA, and this exponential moving average can be your guideline as to when we are going sideways and when we are not. You can also add another moving average if you choose, maybe something that's a little quicker. But nonetheless, for now, I'll just use this example. Notice how from the beginning of 2024 to the present time of recording, right around the middle of July 2024, the 50-day EMA is essentially flat. There's a little bit of a reaction here and there, but you can see clearly we are between these two areas that I mentioned previously of 1.11 on the top and 1.05 on the bottom. With that being said, traders then begin to focus on whether or not one currency is going to be beating the other. And in the last almost 2 years, it's been pretty choppy. This is particularly common in the euro, as it is the most heavily traded market that most brokers will offer. So quite frankly, it's just a lot of back and forth. Underneath, you have the stochastic oscillator. This measures an overbought or oversold area in a consolidation. So it doesn't work particularly well in a trending environment. For example, you can see that in September of 2023, we did have a pretty significant sell-off. And while we did not leave the overall range, we clearly had a downtrend going for a while. Notice how the stochastic oscillator, the lines are just chopping back and forth. The idea is that if you get the moving averages of the stochastic oscillator above the 80 level and then see a cross and they start to drop, that's a sell signal. That means you are overbought. Conversely, if we are below the 20 level and you see a cross and the markets start to push the moving averages higher, that means that we are oversold and the momentum is swinging back to the upside. So a trader that is trading this type of environment quite often will just simply sell on a crossover above 80 and buy on a crossover below 20. And that, in a lot of ways, would be the purest way to trade this. So as I zoom out even further, you can see just how the market had been trending for a very long time before it bottomed. It bounced about 2 years prior, and since then, we really haven't anywhere to be. Let me go ahead and put on another chart. This is the New Zealand dollar against the US dollar. And if you zoom out, you can see that it also has paid attention to a couple of levels. The 0.58 level has been support. The area right around 0.61 has been important. But notice the extreme is closer to 0.63. So longer-term traders are paying close attention. Notice how recently we had seen a bounce from the bottom of this range and also got an extreme oversold condition in the stochastic oscillator on the daily chart. In fact, we reached as low as 5.91. Once the stochastic oscillator started to cross and start heading higher, that was a sign that we could be buyers. So this is what it looks like from an extreme far distance. Let's see what this looks like when you are talking about shorter term charts, which most retail traders will focus on. So I will go to the US dollar against the Canadian dollar, and I will go from a 15-minute standpoint, and I will start to zoom out. So as I zoom out, notice this entire area for several days had been bouncing around basically between 1.3750 and down here at 1.37. So it's a 50 pip range or so, maybe closer to 45. As we flatten out, it does make a certain amount of sense that traders will be worried about, is this going to be more overbought or oversold? And you'll notice that the stochastic oscillator got extremely overbought over here. And then over here, it got oversold and bounced. And then over here, it got overbought and then fell and so on. It just continues back and forth. And the idea, of course, is, we sold off here, and this would have been in a downtrend, and that would have been a significant bounce in a downtrend. So you really don't start to stabilize until you see the moving average basically flatten out. So at this point, you can see that there is a certain amount of support here at 1.3725. So you start to begin to establish your range. Notice we are oversold. We are overbought. Down here at the bottom, we're oversold again. We're overbought again. We're oversold. We're overbought, and so on. Is this perfect? The answer, of course, is no. And eventually you reach an oversold condition over here, and the market continues to drop, but it does bounce back up to the area. So your losses wouldn't have been horrific. And in fact, in this environment, you would have been down about 20 pips. But let's just say you got stopped out. You'd be looking at 1, 2, 3, 4, 5 trades that worked out in your favor and one that did not. If you can win 5 trades with reasonable risk management and lose 1, then you are more likely than not going to be a very profitable trader for the long term. I will go over to the DAX, and in this case, I will take a look at the 30-minute chart. And in recent action, as I record this, we have seen a pretty obvious range between basically 13,350 and 13,150. Notice how we had shot straight up in the air, after that came crashing down, bounced a little bit, and then started to flatten out. Well, you had multiple trades here where we crossed under the 20 level and then turned right back around as a buying opportunity. We did it again. Over here, we got a cross, but we were not oversold, so you wouldn't necessarily sell that. Here, we got an oversold and oversold condition, followed by an overbought condition. We got an oversold condition, and then it finally failed. So again, you had 3 or 4 potential trades to work with and collect more profit than losses. So I'll open up another chart. And in this case, I'll take a look at US oil. This is a market that has been range bound for quite some time. And on the daily chart, you can see just how flat the 50-day EMA is. So again, you can look at this from a longer term perspective, and you can see clearly that between $84 and $72, it seems like we just don't have anywhere to be. So why not take advantage of that? Right here, you started to bottom out, but the stochastic oscillator gave you a little bit of a heads up before that. Once we started turning in the other direction, that was a sign to buy. Your market over here got way overbought and we crashed. We bounced again, crossed over. We weren't necessarily overbought, but we crossed over. Then we got oversold here, and you can see entered a range of extreme volatility. You might have taken a loss there if you just took the stochastic oscillator, but you also would recognize that you were not at major support, and that's the trick here. You need basically a flat EMA or an EMA that seems listless, major support or resistance, and the technical indicator. Over here, the stochastic oscillator, major oversold signal, and it bounced all the way up to here before it got an overbought signal. You may have decided to take profit there, or you may have moved your stops to break even, something to that effect. Once we get all the way up here, you can see that we crossed right at the edge of overbought and then fell again. And then over here, you had an oversold signal, but again, it really wasn't at the major level. Down here, you got a cross and we bounced. That being said, it does take a certain amount of patience to trade this way. You need a market that is telling you very clearly that it has nowhere to be. This does tend to work really well on the ultra long-term trades. So in this environment, I'll take a look at the weekly chart, and you can see that somewhere around here, around June of 2023, the market just went flat. You can take advantage of these two levels, and this stochastic oscillator can give you a little bit of confidence. So notice here, oversold, we just bounced significantly up to an overbought condition. And now we bounced again from a borderline oversold condition. Again, look for that flat EMA. If you choose, you can go with a shorter term EMA, for example, the 20, and it may flatten out a little quicker. But really, at the end of the day, this is a market that is very flat regardless. The stochastic oscillator isn't the reason to take the trade, it's your tertiary reason. So pay attention to the stochastic oscillator with flat or flat-ish moving averages as we're banging around between two major levels. Remember, 2, 3, 4 wins and a loss, that means you're a profitable trader.